What are capital gains taxes? Well, they are taxes on the growth in value of investments incurred when individuals and corporations sell those investments. Hello, my name is Nikki Young, and I'm an enrolled agent with Latino Tax Pro. We're an association dedicated to serving the needs of the Latino community through tax preparation training in both English and Spanish. Almost everything you own or use for personal or investment purposes is a capital asset. Examples include a home, personal use items like household furnishings, and stocks or bonds held as investments. When you sell a capital asset, the difference between the adjusted basis in the asset and the amount you realized from the sale is a capital gain or a capital loss. Capital gain refers to the increase in value of a capital asset or an investment security upon sale. Simply put, if I buy a widget for $1 today and then sell it in 2 years for $10, my capital gain is the difference, or $9. Now, I don't make money until I sell my widget. Doesn't matter what the current value is, my realized gain only happens once I sell. Now, realized gain then are those that have been actualized by selling an existing position for more than what was paid for it. An unrealized gain is that which has increased in value but not sold. They have not been realized yet. How about a capital loss? Well, that's incurred when there is a decrease in the capital asset value compared to an asset's purchase price. Realized gain results in a taxable event, but unrealized gains are typically not taxed. They add to an asset's originally reported book value at the time of purchase and can occur on all types of assets and investments held by a company. In other words, if the stock you hold goes way down in value, it's not worthless until you sell it. As my economics professor used to tell me, buy low, sell high, which is the opposite of what happens many times. Now, a capital gain may be short-term, which is 1 year or less, or long-term, more than 1 year, and must be claimed on income taxes. Short-term gains are taxed at ordinary income tax rates. Here's an excellent chart to show the difference in taxability between short-term and long-term. The intent is to get investors to hold their stocks for longer than a year to better help the overall economy. So take me, for example. My taxable income runs between the $77,401 that you're seeing on the chart to $165,000. So short-term gains would be at a 22% ordinary tax rate, as opposed to if I just hold it a little longer to get over a year, it's only going to be 15%. Now consider if I made a whole lot more money. I wouldn't mind. 400,001 to 479,000 in taxable income. My ordinary tax rate is 35%, but the long-term capital gains tax rate only still 15%. Now, Congress is debating and considering changing that. So let's keep an eye out, and as soon as we hear and they make something formal, we will let you know and bring it to you. But in the meantime, it's a much better rate to stay at the long-term capital gains tax rate. Capital gains and losses are then reported on Schedule D, which is divided into Part 1 for short-term and Part 2 for long-term. All capital gains and losses are added together to determine overall gain or loss. If there is a loss, it is limited to $3,000 per year. I have a client who was a day trader 1 year and actually ended up losing over $100,000. Unfortunately, he could only take $3,000 per year. So hopefully he'll be around for the next 35 years to be able to get all that loss. Now, if you have a net capital gain, a lower tax rate may apply to the gain than the tax rate that applies to your ordinary income. The term net capital gain means the amount by which your net long-term capital gain for the year is more than your short-term capital loss for the year. The term net long-term capital gain means long-term capital gains reduced by long-term capital losses, including any unused long-term capital loss carried over from previous years. The slide shows lines 14 and 15 from Schedule D, where you carry over any losses from previous years. Virtual currency is a digital representation of value other than a representation of the US dollar or a foreign currency, because that's classified as real currency. And virtual currency functions as a unit of account or a store of value and a medium of exchange. Some virtual currencies are convertible, which means that they have an equivalent value in real currency or act as a substitute for real currency. It is taxed as any other asset since you purchase it initially for a certain value and pay tax on the difference when you sell it, as long as it went up in value, of course. It's the latest craze on the market, and be sure to look for a future presentation to review it in more detail. So thank you for your attendance and attention. We hope you found this presentation beneficial. If you want to see more topics in the future, be sure to like and subscribe. We'd love to have you visit our website at latinotaxpro.org or call us at the number shown on the screen. Until next time.